meeting. October 14th, 10 a.m. We'll call the meeting to order here. We have all of our pension trustees and finance and legal professionals in place. Before we turn over to the investment reports, I want to welcome our newest appointee to the pension board, Rita LaRue. Rita is longtime Upper Darby resident and Director of Community and Economic Development here in the township, also President of the Friends of the Tower Theater District. So deep community ties and well connected to our fire service and township government. So Rita, welcome aboard.
Thank you very much. Thank you.
Sure. So everybody, when we go around and you have a moment to do your reports, or if you're doing the acknowledgements, if you want to just go ahead and take a second to make sure Rita knows who you are and who you're with when you are doing your part of the meeting, I think that would be very helpful as we go through. With that, the next item on the agenda is the investment reports. So for the first investment report, I will turn over to Mike Glacken from CBIZ.
Welcome, Rita. My name's Mike Glacken, president of CBIZ INR. We've had the privilege of working with this committee for over a decade. We manage half of the investments in the fire pension plan. And our approach is what's called an all market indexed passive approach, using investments from firms like Vanguard and iShares to try to own. Our clients really remember three things. One, if you ask them what they own, they own every stock from every company in the world, and they're lending money to almost every corporation in the U.S. government. And then we concentrate our efforts on trying to get the most return that we can given our charge. So that's kind of what we've gotten known for, being a lower cost, all market approach and concentrating on the allocation, which is 90% of the test grade. So we've been given the charge for the fire pension as the more aggressive managers of the two. So given that, our lean is much more towards equities than Paul from wealth management. So in strong stock market years, we perform better. In weak stock market years, they perform better. But we concentrate and work together in coming up with the allocation strategy to do the best we can given the risk constraints to get the most return to meet the assumed interest rate over time. And that's worked out extremely well for the group. I don't want to answer for the committee, but I'll let the other folks and Pete expound on that. But we've traditionally used a 65% equity, 35% fixed income strategy together in order to try to hit that assumed interest rate over time, and it's been successful. So you've taken on slightly more risk than your normal municipal defined benefit pension plan, but you've been rewarded for over a decade for doing that. Our charge is more of a 75% equity, 25% fixed income. Therefore, what I said before, we're the more aggressive managers of the two, right? I'm going to share my screen now and bring up the year-to-date performance report. So for the year, also for Rita's benefit, but everybody else's, as Joe Duda was saying in the beginning, as people were jumping on, this valuation, which is based on, so every other year, Rita, the valuation's done in order to take a look at how the pension plan stands, the funding level, but most importantly, that helps Vince determine what that MMO is going to be for the following year. For 2022 and 2023 is based on the valuation that Joe Duda did based on the cost of benefits, the valuation, and then performance of the pension for 2019 and 2020. So it was an extremely strong valuation year because 2019 and 2020 were very strong years. 2021 continues to be more of a risk on leaning towards stocks so far year. I will put in my 2 cents after I go through the performance on what we expect as far as volatility in the marketplace. But so far year to date, we're up just over 9% as of 9/30. Since inception, up over 9.55% since 2011, when we started using the all market index approach. Last year up over 16%, and the year before up over 21%. So very positive as far as returns go. Year to date up over 9. We've had using an all market indexed approach, we concentrate on first, we're 75% equities, 25% fixed income. And then we spend 95% of our time determining how much goes to international versus US, how much goes to small company stocks, mid company stocks, large company stocks. So even though we're an indexed all market provider, we also do what's called strategic management. And that's also helped historically. This year, what we've done is, I'm going to go to page, here we go. So what we did this year, thinking that interest rates were going to climb a bit, and we thought this was going to happen based on lack of supply, not due to normal inflation pressures. So we moved a bond portfolio to a shorter duration so that if interest rates went up, it would be impacted less. So on the bond side, you had a roughly flat year so far this year at negative 0.12%. The total bond market is down about 1.6% so far as of the end of the third quarter. And most retail investors don't realize the bond market can lose money. When interest rates rise, folks can get a higher yield by buying bonds now than they could 6 months ago. So what's happened is that strategic move that we made by lowering the duration has benefited the fire police pension plan by about 1.5% on the bond side. So that strategic move ended up being pretty strong, especially in the first and third quarter. In the second quarter, didn't work out so well, but year to date, a 1.5% over performance of the bond market. And the bond market is harder to beat than the stock market. So using an all market index approach, that worked out pretty well. On the total stock market side, the stock portion of your portfolio with CBIZ INR was up 12.45%. When you squish together large cap US, small cap, mid cap, and then international, that total stock portion was up 12.45, when the total all world stock market was up around 11.28. And the additional performance came from a lower lean towards international than the market and most institutional managers, and a lean towards mid cap and small cap stocks, which worked out pretty well in the first quarter and are working out so far year to date. So our overall performance was up about 9% so far year to date. So things keep rolling along. However, I do want to bring up the fact that we take the opportunity every time we meet with this committee to remind them that almost every year on average, the stock market declines roughly about 14% at some point throughout the year. But 75% of the time, the stock market rebounds and ends up being positive. So look at this slide. you could see there are much more positive years than negative years tracking back to 1980. And all these red dots are what we call those opportunities in time where the market has dropped on average about 14%. And if you look here in 2020, the market was down about 34% when we were introduced to Vince and some of the committee members for the first time. And the market dropped about 34%. And we're coming in and telling them we're going to sell bonds and buy stocks cheap. So the second thing, Rita, most of our clients always remember is we're always investment shoppers. So whatever asset class drops, we're going to take advantage of it and buy it cheap. But what I wanted to make sure everybody understands in the main point from this slide, we do over 100 municipal pension plans now, and everybody keeps asking me when the market's going to crash. Well, you should expect a downturn every single year. We just haven't had one yet this year. The biggest drop has been -5%, and we've taken advantage of that, and we're going to continue to take advantage of that. But I do want you to know and expect market downturns should be expected, and we'll take advantage of them. But so far this year, we've even benefited from just in October, your performance has gone up to now you're at a positive 10.27% with our strategy, again, because leaning more towards equities than Paul's firm. But we're being rewarded again for staying the course and rebalancing. The last thing I want to bring up is, well, two things. In January is when we come to the group and go through capital market assumptions and what we expect to get from the plans as a whole. And that's what you do when your GASB report, when Joe Duda compares what we expect to get in a return compared to the assumed interest rate that we've been using. And we're very proud of the teamwork that we've had with this committee in managing, that assumed interest rate versus expected returns. And the township's been very, very prudent, especially working with this committee to take a look at that and monitor that ongoing. So in January is when we come and tell you what we expect to get. That's one of the core meetings for me. These guys might be chuckling because it might put them to sleep a little bit, but that's our favorite meeting where we tell you what we expect to get. Last thing on our agenda was just to also inform the committee that we will be reducing the management fee down to 15 basis points. We just did that on the police side. We're going to do the same thing here. So we'll be forwarding that advisory agreement, I guess, to Jim and to committee for review. But that's the last thing on our agenda item for performance.
That's before I open it up to questions, I just want to say that's really outstanding, Mike. We appreciate the lowering of the fee tremendously. For folks who might not be aware, we just went through an RFP process on the police pension board side, and it was very interesting and successful. We learned a lot about our program and how our investments are made and how we're charged, and we were able to save the plan a lot of money. And so if you see a police pension board member, as much as it might hurt the heart of a firefighter, thank them for helping us save a bunch of money on our investment fees on this pension plan. So thanks, Mike. We really appreciate that. And if anybody has any questions for Mike on the investment report, please go ahead.
Hi, Mike. This is Dave Heyman. I'm looking over the report. I can't see what's on the screen, but I'm pretty sure I've got the same thing in front of me. I have a question about the use or the selection of your indices that you're using as benchmarks to compare the performance. you're using the MSC ACWI, and basically for everybody, what that is, it's an index to represent equities around the world, and that index it's I'm gonna try to get my numbers here. I'm sorry, I'm starting to lose myself here. The CBIZ portfolio piece that you're managing, as you said, is a 75% equity, 25% aggregate bond, where the international part of that is 26%. The U.S. portion of the stocks then are, shoot, sorry about this. I had this written down. I got myself confused.
David, I could give that to you because we run that.
I'm just questioning the use of the selection of that index and wondering if instead of one index to represent equities that doesn't really match the portfolio, are you able to create a composite index that more precisely reflects what the holdings are?
Yeah, I'll answer that two ways. First, we're actually because we're the all market approach, we're comparing ourselves to the all market index and bond index, right? Because we are the ones determining, instead of using an all market cap, which would put us roughly 55%, 50% domestic, 50% international. Our exposure is actually 35%. If you look at how it breaks out pro rata, David, if you're just looking at the stock portion, right, which is 75%, we're roughly, actually, you're right, it's like 26%, but 26% of 75% is actually 35%, right? So we're 35% international versus, if you look at how the stock market breaks out, it's 50% international, 50% stocks, right? So we're the ones saying we're moving that to 35% rather than 50. So there is a positive decision being made on our end. Most institutional managers, if you look at iShares, BlackRock, Vanguard, they're at least 40 to 50% international. Most of our counterparts, if you look at target date funds across the country and institutional management, especially right now, their feeling is international so low that they're increasing their exposure. We feel contrary to that, but that's one reason why we've used that all market index approach, because that's how the market breaks out. That's number one. Number two, though, Wealth Management does an all-inclusive quarterly report where they are benchmarking, the way that you just, in the consolidated report, Paul is using a consolidated benchmark. And that's combining both Wealth Management and us together to take a look at where things stand holistically. Because on the other side, we also have made determinations historically to lean more towards mid cap and small cap stocks. If I just keep changing the benchmark to mirror where we are allocating differently than the marketplace, then we're not getting credit for those strategic moves that we've made for the last decade. So things that have helped us beat the benchmark over time has been that lean towards mid cap, small cap. We've made strategic decisions on the bond side. So last year, I overweighted dramatically high yield on April 8th when the market got pummeled. If I would just change the benchmark to go more to a high yield bias, we're always going to be just in touch with the benchmark and not get credit for the strategic moves that we're making. We just met with the Vanguard institutional folks, and they're recommending a 50% at almost 50% allocation to international, and we're not. So that's the long-winded answer. We are in joint with Paul, and I'll let Paul explain this when he goes through his performance. There is a consolidated benchmark that he's using to compare how the plan's doing as a whole against a comprised total benchmark. Was that, I apologize if that was too long-winded, David.
No. I appreciate your explanation. I don't want to carry this on as, to dominate the conversation with it. I was just curious of how you choose these benchmarks. However, if you're basically market timing based upon what your forecast for capital market assumptions are. So, like, for example, you're talking about leaning toward the mid and the small cap. Your mid and small cap allocation is 13%. I mean, that's not heavily leaning toward mid and small cap. But if you are moving these allocations around the model, that means we are not using a consistent asset allocation model, and therefore benchmarks are pointless, right? Because there's no benchmark that means anything to us if it doesn't reflect the underlying holdings of the portfolio. So
now, and this is done in every investment strategy is doing well across the country. CalPERS, not the state of Pennsylvania, obviously. We are still a passive benchmark advisor. So when we do the capital market assumptions, and what we're doing is breaking it out and saying, what is the safest way to get the highest return out of 75% stocks, 25% bonds? We are in no way market timing. We're doing the opposite. So what we're doing is we're taking a look at what allocation gives us the biggest reward as far as risk versus return, David. So right, if you look over the last 10 years, mid cap and small cap stocks, based on what their price and earnings ratio is today, give you a pretty solid, you're getting them on sale compared to where large cap growth has run. And also we're not just, when you look at that indice, the small and mid, Vanguard's large cap growth and large cap value also contain a portion of mid cap as well. So we truly are concentrating 95% of our effort on the allocation strategy, David. And we are making decisions that have been strategic, not to time the market, but based on exactly those capital market assumptions, which is much different than an active advisor who's saying, look, I like Apple versus Google. We're not doing that. We're looking at asset allocations, as I told Rita in the beginning, 3 things that our clients remember, that we own everything, that typically we're buying the asset class on sale, which is the conversation you and I are having now. And 3, 75% of the time that the benchmarks do better than active management, and we're using that strategically. In fact, we're probably more passive than BlackRock and Vanguard, right? So we are not timing. In fact, we're rebalancing and taking advantage of downturns. We're not moving in and out of the markets.
Oops, oh, I was on mute. Thank you very much for your answer.
May I take it from here?
You got it, Paul.
All right. Good morning, everybody. My name is Paul Spiritus. I'm the Chief Investment Officer at WMS Partners in Baltimore. And Rita, it's nice to meet you. Just for your benefit, what we do, as Mike has outlined, is we manage a portion of the pension, and we manage it with a more conservative mandate. In addition to that, we track the overall asset allocation and investment performance for the plan. and adjust our asset allocation relative to the investment policy statement, which is the governing document for the portfolio, relative to what Mike and his team are doing. So as that portfolio is growing and as it, is more aggressive relative to the overall portfolio, we then have to become more conservative. But then again, what we also do is we also report on the entire plan as well. And that's what you're looking at here on the screen. Hopefully you all can see my screen, I hope. Okay, all right, I see a thumbs up. All right. So here is the overall plan as of the end of the quarter. And from an asset allocation perspective, the portfolio is in line with the sort of high band of our asset allocation policy, meaning that the equity portion of the portfolio is roughly about 66%, 67% of the overall portfolio, and the balance is in wealth preservation and cash. The total value of the portfolio as of the quarter was about $45 million. Year to date, the overall portfolio is up about 8%, trailing 12 months up 20%, trailing 3 years up 11%, and then over the past 5 years, 10% annual returns. This particular page shows the breakdown of the performance by sector. The capital appreciation growth part of the portfolio has, as you can see, has outperformed the All Country World Stock Index, which we were just talking about, in each of the different periods of time. The flexible strategies, which is something that we employ in the portfolio here, which are strategies that allow for growth risk, have also outperformed that blended benchmark. And then wealth preservation has done the same relative to the Barclays Ag. What I will say, and I'll pull up now the WMS portion of the portfolio, which as of September 30th was about $18 million. Our portion of the portfolio, what we have done historically is our approach is a little bit different than Mike's in that, again, the mandate that we've been given is a conservative one. However, in addition to that, our approach to managing the assets is a little different as well. We take more of an active approach to investment selection, as well as strategic asset allocation, just like his team does for you guys as well. We also historically have done a lot of private investments here at WMS Partners, and we employed one of those strategies in the portfolio for the firefighter pension for the greater part of the past, having liquidated that strategy about a year or so ago. It's something that I think continues to make a lot of sense. I know that with illiquid strategies, it's a little bit different than what you may be used to in the public markets, but I do believe that there's a premium for those private strategies that continue to make a lot of sense, particularly on the private debt side of things, because I think that there's a real opportunity for return that you're not getting in the public markets where you have, a 10-year treasury at about 1.5%. Our outlook, I should have probably given you before now, but our outlook is, we believe that the equity markets will struggle with a number of short-term factors. I don't think at this point that any of those will threaten the big picture outlook of, a pretty solid economic recovery around the world coming out of the pandemic recession last year. However, we do think that the capital markets, both stock and bond, have significantly front-run the positive fundamentals. And the reason is because when the Fed and all of the central banks around the world last year reacted to the pandemic by, cutting rates to zero, buying bonds in QE, and then also with the federal government sending checks out to folks who needed it, to small businesses who needed it, essentially what that did was it built a bridge between the beginning of the pandemic and what will eventually be the end of the pandemic from an economic perspective. And that's why we saw such a very quick rebound in the capital markets after the very quick sell-off that we saw in the February to March period. I'm sorry, the March to April period last year. February to March period last year. And so basically what historically has taken several years to transpire all happened within several months. And so we're of the view that the fundamentals have to catch up. And we're starting to see that, but markets still are very expensive. And so the best case scenario in our view is that we kind of have a consolidation phase where the markets move sideways, albeit in a volatile fashion, as those fundamentals catch up. The real risk, though, is that something comes in and sidelines that. And what that it could be something that's exogenous to the market, as it relates to the pandemic. We all could think of horrible things that could happen. Or it could be something within the financial markets. And what most likely that would be worries about inflation, worries about the economy slowing down, and interest rates spiking. We don't think that's the base case scenario. I think that there's enough that is supporting the economy that will keep things afloat. But again, I think that the economy has to catch up with the markets. And that's why we see these really strong returns, particularly in the equity markets over the course of the past year and certainly over the course of the past decade. So what we're doing in your portfolio, again, is trying to rebalance around Mike and his team, trying to stay conservative and balanced for the portfolio. As you can see here, our asset allocation is roughly about 46%, 46% in equities, and the balance is in wealth preservation and cash. We're at about $18 million as of the end of the quarter. Year to date, the portfolio is up about 6.5% for that first 3 quarters of the year, about 16% on a trailing 12-month basis, 10% annually for the past years, and then 9% for the past 5 years. When you break down the performance by sector, you can see on the capital appreciation side, we have performed the world stock index over each of these periods of time. And then on the wealth preservation side, which again is a much larger portion for us because of that conservative mandate, we've outperformed the Barclays Aggregate Bond Index over each of those periods of time as well, in a period of rising and falling interest rates. And a big part of that, again, on the 5-year side of things, was because of that private investment that we had made, the LLC, the Chestnut Fund LLC, which was discounted cash flows. So I've gone through a lot there. I'll kind of pause and see what questions or concerns anybody has.
Paul, what was the year-end return last year?
For the calendar year?
Yes.
Okay. For the entire portfolio, Jim, or just ours?
The entire portfolio.
Okay.
It was around 16%.
Yeah.
I think I saw that earlier.
$16, 15.7%.
Yeah, okay.
Thank you.
Of course. Okay, well, thank you all. Again, the one suggestion that I have in terms of looking at some other private investments, I'm open to having that discussion. I don't want to take up more time than I'm due here, but I do think that it's something that we should consider. I don't know, to the degree that the group is open to it. It's worked for us in the past, and we vet a lot of those strategies, and I think it's something to consider. Particularly because, this is a portfolio that has essentially, an infinite time horizon for the most part. So the ability to be able to assume a little bit of illiquidity risk, I think, is there. Thank you all.
Okay, that sounds good. Thank you, Paul. Before I let you go, I mean, Michael broke some big news there on the CBIZ fees. Did you not want to break any news on the WMS fees?
I don't have any news. That's not something that I wasn't part of a RFP, so I apologize. It's news to me as of today.
No, fair enough. Sorry to put you on the spot there.
Yeah.
Thank you for the report. All right, so if there are no more questions on the investment reports, I will move to authorization of the bills. And unless there's an objection or a concern, I will read them off in a batch and we can approve them all at once. Is that okay, Chief Huff?
That's fine.
Okay, great. So authorization of the following, payment to Duda Actuarial Consulting for GASB 67, $1,500. Payment to Willig, Williams, and Davidson for legal retainer, $3,750 for 2 quarters. So that's 2 payments to Willig, and Davidson of $3,750 each. And payment to Kara M. Gavin for secretarial services for the 4th quarter of 2021 at $350 per quarter. Do I have a motion to approve those bills?
Motion to approve.
I have a quick question. I'm sorry.
Yeah, sure. No, go ahead, Rita.
I see the one payment for legal retainer January through March. The second is July through September. Is there an April through June?
We do bill quarterly, Rita. So I'm not sure why there's that discrepancy in your records.
Oh, interesting. So I wonder if there's a typo on the agenda or if we actually paid the bill in the middle.
What I can tell you, Vince, is that our record showed that the first 2 quarters had already been paid, and we just sent the 3rd quarter bill earlier this week, which I think Kara did put on your agenda. But we're showing only the 3rd quarter bill as outstanding.
Okay, so I guess what I will do is, and I apologize, Chief, we'll just have to ask you for your motion again. I'll move to amend the reading, sort of striking the January to March payment, but leaving on the authorization for the July to September. So it'll be just one payment of $3,750 to Willig, Williams, and Davidson. And special thanks to our newest board member, Rita LaRue, for the big save there. Thank you. Do I have a motion to approve now that we're sort of on board here?
I'll make such a motion.
Thank you. Do we have a second?
I'll second the motion.
There we go. All in favor, say aye.
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 Any opposed? Hearing none. The bills are approved. And excuse me. With that, I would like to move to the acknowledgements. And as I've sort of done in the past in the early going, what I would like to do with your permission here, Chief Huff, is ask you to do the acknowledgements. I've had the opportunity to work with and get to know some of these folks a little bit, and it is important that everybody understands that the mayor and I respect and appreciate their service and congratulate them on their retirements. But I think it's more appropriate for Chief Huff to run through, having really worked closely with these people and known their careers better.
Sure. Thank you, Vince. I'd like to acknowledge the following members that have retired since our last meeting in February. That would be Deputy Chief Brian Boyce, Firefighter Vince Gasparo, Fire Marshal Dan Lanny, Fire Training Coordinator Emil D'Alessio Sr., Firefighter Mike Fusco, Firefighter Mike Osmond, and Firefighter Martin Kelly. I would tell you that a combined years of service is well over 200 years of those gentlemen be added up to our township.
Yes, very, very impressive. Thank you very much. And we congratulate all of them and wish them well. I also want to note the passing of Noel Evans, the widow of the late Byron Evans. Chief, I don't know if you want to add anything on the Evans family, but our sincere condolences to the Evans family as well.
Absolutely. Noel and Byron have 3 sons, and certainly we express our condolences to all 3 boys.
Wonderful. Thank you. So moving on to old business, we have the status of the fire pension plan revised description. Jim, I don't know if that's you or if that's Chief Huff. Yeah.
Go ahead, Jim.
Yeah, I think we prepared and circulated a revised SPD. Have not received any comments. I think perhaps with an adjustment for the date of issuance, it's ready to go. Unless there are any questions or comments at this time.
Okay, so I think maybe what we should do, I don't know if we have to formally adopt it. Maybe we should set for the agenda of the next meeting, potentially a sort of formal adoption, and that'll give us a little bit of time for Rita to review it and to see if we want to have any comments. How does that sound to the group?
It's
Fair
fine.
enough.
Okay, great. So I think does it any other old business?
Well,
Vince,
I have,
we need Joe Dugan. There you go.
yeah, I was going to talk about the actual evaluation.
Oh, fantastic.
I won't be long. I won't be long. I just want to talk about where we stand as of 1/1/21.
Yes, thank you.
And I'm just looking here. How do I share the screen? Let me see if I hit click on this button. And trying to figure out how to do this. What do? You share the screen and then.
Yeah, so down at the bottom middle, there should be a button that says share screen, and
Right.
then
I'm trying to get to my desktop here because I have the exhibit.
I guess in the top right, you might have to sort of shrink the window in order to get back to your desktop.
Let's see here. Sorry, everyone. I'm not used to doing this. Nope, that didn't work. Let me share screen. Got a big picture of you, Vince. Okay, appeared on my
Joe,
screen. That didn't work either. I guess
You want to email, Joe, you want to email it to me and I'll bring it up?
Yeah, can you please? I think
Yeah.
maybe we did that last time, actually, Mike. Okay, hold on a second here. A little technical difficulties, everyone. Just please bear with me.
Well, while Joe and Mike are doing that, I appreciate it, Mike. I will just note to the board that Joe was extremely helpful in the preparation of the actuarial report and actually helped us a great deal reduce the MMO for this year on the fire pension plan. And so that was certainly much appreciated and very helpful. Yeah.
Thank you, Vince. Okay, I'm going to try to get back to the gallery. There we go. Okay. And did you get it, Mike?
Not yet, Joe.
Okay. Well, let me, Rita, for your information, I'm the actuary for the pension plan. Welcome to the board. Let me give you a brief overview of Act 205, which is the statute that I have to follow for your plan and all the plans that I service here in Pennsylvania. We do evaluation, and you may have gotten bits and pieces of this a while back, but essentially what happens here is we do evaluation once every 2 years, and we do it on the odd year. So the last one that we performed for the fund was 1/1/19, and what I have here today. Matter of fact, I used it to prepare your MMO, and the MMO stands for minimum municipal obligation. It's the minimum contribution for the township. And, I used the 1/1/21 results for the 2022 budget. And the numbers came down quite a bit, I think around $400,000. So I was very satisfied with that. And what happened here was we had a lot of investment gains built up into the fund for 19 and 20. Okay, so if you think about 1/1/19, 1/1/21, you're looking at the investment results for 19 and 20, and it was a very, very good period. So we took advantage of it and computed, the valuation results as of 1/1/21, and then did the MMO thereafter. So I was very, very happy that we got it done, and the township is enjoying the savings. Mike, did you get a hold of my email yet?
Not yet, Joe. Did you?
Not yet.
Looking at cbiz.com.
I thought so. You got, maybe, is it in spam? Did you look?
Yeah, I looked at spam.
Okay.
How come your emails always go to spam, Joe? That's,
I don't know why.
I'm kidding.
All right, let me try it again. M. Glacken at cbiz, right? .com.
Yep.
Okay, here we go. One more time. Well, I guess what I'll do is I'll just talk about the results. Essentially, what happened with the 1/1/21 valuation, your unfunded liability came down quite a bit. As of 1/1/19, it was 14.3 million. And as of 1/1/21, it was roughly about 7.7 million. So it was basically cut in half. Okay. And using that valuation, doing the calculation of the township's MMO for next year, we came in with a number of 2,101,841, and I believe last year it was it was 2,543,984. So it was a savings of over $400,000. Okay, so we'll be using this valuation for the 2023 MMO, and then we'll be remeasuring the plan as a 1/1/23, for future MMO. So we work in 2-year cycles, essentially. That's what happens. And we're off to a good start. I think I saw the combined return to be about 8% as of September 30th. And we're assuming 6.75%. So hopefully we'll be able to get 13.5% for the 2-year period, and maybe we'll do better. And hopefully those results will be better than the 1/1/21 numbers. So, and I guess you never received the email, Mike.
No, Joe, I don't know what the heck happened.
Okay, I don't know either. I sent it twice, actually. My apologies to the board. I'm not used to sharing the screen, so sorry about that.
Well, that's all right. We can get you a screen sharing tutorial. And if you want to send it to me and Megan Brown, or
Yes,
we'll
I
make
will
sure
do
that
that.
it gets circulated to the entire board.
I will do that.
As long as the board is comfortable with that. Any questions for Joe?
I do have one question, Vince.
Sure.
In our
Oh, there it is. There we go.
up there,
Aha!
Okay, go ahead, Pete.
our last meeting, we discussed about you, Joe, doing the total calculations for the amount of contributions for each member.
Yes.
You were
Yes.
saying that you have all that extra work and overlap. And then
Yes.
I think I'm reading the old minutes. Vince had suggested emailing the request to him and Beverly. What's our status with that? Is there anything we need to do or?
Well, I guess what I need to do is to give you a quote on how much it's going to be for the entire group. I think I estimated, for each one that we have out there for 2021, it would be $300. I think I mentioned that before. So hopefully I can get approval for that. What Pete is talking about is when a retiree leaves, part of his pension is non-taxable. And you do a calculation based on the total amount of contributions that the firefighter put into the pension plan. And depending upon what option he selected, whether it's a joint survivor, a 10-year certain and life, portion of that monthly benefit is non-taxable. The problem we have is the township does not have the total contributions today for each firefighter historically. So what we have had to do was to go back. I think I have contributions as of 12/31/1999, and then I have the AG 385 forms subsequent, for 2000 to the current date. So essentially, for one guy, I have to add up like 20, 20 or more than 20 spreadsheets in order to get the total contribution. So it's a massive amount of work. I really would like to try to do it for everybody, but obviously we have, around 5 or 6 people out there right now, and they'll be reporting this non-taxable amount in their taxes next year. Okay, so obviously I have to get cooking with that, but I guess I was going to ask approval for those individuals at $300 an hour, or not $300 an hour, $300 for each calculation. And then I will give the board a quote to do everybody else. Okay. Obviously there's economies of scale if you go through all the people at once. Okay. Does that kind of make sense? Or, it's a number that the firefighters need. I can tell you that.
And correct me if I'm wrong, Joe, when we talked about this, the newer hires, as we move forward, the township does have that information. So
I think they have. I think I talked to Beverly Wells. I think she has around maybe 6 to 8 years of information.
right. So it's going to self-correct itself moving forward.
Yeah. Yeah. But, when you get we've had quite a few retirements in the last few years, and it's been a lot of calculating. Okay. A lot of calculating, adding up sheets and what have you. Okay. So would like to try to nail that down and try to get, once I have a cumulative list for the 50 or so firefighters, then we won't have to go back and reinvent the wheel here. Okay.
Right.
So
You, any thought on that, Vince, or?
I think it seems to make sense. I think it's something that would be valuable that we need to do. That's sort of my gut reaction. I don't know if any of the other trustees have thoughts.
it's something that's definitely needed because, a portion of your benefit is not taxable. So we do have to calculate that number and give it to each firefighter so they can, complete their taxes. So, we have 5 or 6 of them sitting out there right now, and then we really should do the whole group at one point. So I guess what I can do is I can give you, I'll do the 5 or 6, but then I guess for everybody else, I'll just give you a quote. I'll send it to Vince and Pete.
Yeah, I think that makes sense. And hopefully there's some kind of, I understand the work is the work for sure.
Yeah.
Hopefully there's some kind of economy of scale.
That's what I'm hoping for that too. Yeah.
Yeah. And I guess my question is, if we sort of have to do it, is it something that we didn't do in the past, or that we did do in the past, but in a different way?
We've been just doing everybody piecemeal. And, I've been on the fund for about, 12, 14 years, something like that. And, we didn't really have a lot of retirements years ago, maybe like 1 or 2 guys, if that. but like recently, there's been quite a few. Okay, and and then you were adding another year of adding a few more years of the spreadsheets. Okay, so it's starting to get kind of crazy with 20 plus spreadsheets that you have to add together. So we have a cumulative list as of 12/31/99, but that doesn't help us going forward. Okay.
Got it.
I think it would be smart. I'm sorry, Vince, I didn't mean to.
No.
I think it'd be smart if we get this done. I mean, we need it.
Yeah, you do need it. Yes. So
Yeah.
what I'll do is I'll give you I'll work on the 5 or 6 that we have, and then give you a quote for the others, if that works.
Yeah, that would be great.
Okay. All right. Thank you. Let me just go through this real quickly. I finally figured out how to do it. Sorry for the delay. Okay, here's your valuation results, and this is based off the 6.75% interest rate, and this is as of January 1st, 2021. The normal cost that you see up at the top, you see the total 1,160,084. It's roughly 15.13% of pay. That's the cost of benefit accrual for the active firefighter. So that's a major component of your MMO. And what you need to do is you need to fund that so that the money is there when they retire. Okay. So each year you're going to have a normal cost as part of that MMO component. The administrative expenses based on what Maley provided, roughly about $30,000. Then we developed the unfunded actual accrued liability. The present value of all benefits under the plan, as you can see, is about $62 million. The accrued liability, which is the portion that we're really interested in, for the actives, item 8A5 is $28,263,475. And for the retirees, $22,486,782. So we have a total liability of $50,750,257 and assets of $43,060,596. So that gets you to the unfunded liability. The liability is greater than the assets. So the unfunded liability is $7,689,661. So as I said before, it came down from 14.3 million. Your assets went from 29.7 to 43 million. So, and I think I saw earlier today, where were you at? Like 45, 46, I think I saw. Is that accurate? Okay, but do keep in mind your liability grows. I mean, 2 years ago it was 44 million and now it's 50 million. So if I had to make an educated guess, extrapolating, you might be looking at 54 million. Okay, so obviously we need to, keep generating revenue to pay off that unfunded liability. The next page is the MMO, and I was talking about it earlier. The payroll, the estimated salary for the payroll, that actually went down because what the law tells you to do is you look at the actives at the time of determination. So we had a bunch of guys retire during 2021. So they're out of the calculation, which makes sense because they're retired. Okay. And we multiply that times the 15.13%. So as you can see, the normal cost is 908,207, which is, a lot lower than the 1,160,084 that you saw on the other page. The total payment towards the unfunded liability is 1.5 million. Expenses about 24. That's a percentage of pay. So since your salary dropped, that drops as well. So your total annual bill is about 2.5 million. The firefighters are kicking in 6% of pay, or 360,000. So we have an MMO of 2,101,841. Now, I always get asked this question: what happens if your unfunded liability becomes zero with a given valuation? Well, that amortization payment, item number 4, 1,529,528, that becomes zero. So in essence, your MMO would go under $600,000 if you were totally, if you were fully funded. Okay, and then we could have a party at that time. Okay, so if that should occur, I mean, we made something, we cut it in half. You never know. Okay, you never know what can happen. hopefully we don't see any 2008. I'm telling you, I don't want to see any, crazy, crazy numbers, but the scary thing about all this is 2020, when the pandemic hit, what was the market down, guys? What, like -38 or something like that? But then we recovered right after that, fortunately. But man, I mean, could you imagine what the ramifications of that would be? So, we gotta watch it. And we have a lot, if you go back to that first page there, a lot of your retirees or a lot of your liabilities with the retirees, you see 22 million out of 50. So we're starting to get a little bit top heavy there, so, we gotta watch the risk, and we gotta watch a lot of things, So, but
Pete, he wasn't calling you heavy.
That's what I took it as.
Okay, you're top heavy. No, geez, that didn't come off very well. I apologize. Rita, I've been blasting through this because I've been practicing for 40 years. I hope you can understand some of this. I mean, do you have any questions, comments?
I have a little bit of experience with this, so it's
Okay,
been
good.
very clear. And
Okay,
I thank you for detailing it for me.
Okay, thanks. I appreciate that. Okay. I always try to keep my presentation at 10 to 15 minutes because I know everybody has valuable business to attend to, but that pretty much completes what I have for today. Does
All right,
anybody
great.
have any questions?
Nope.
Anybody else that I blew past or missed on the investment report? Sorry about that, Joe.
Okay.
And again, really was very, very helpful and valuable. Joe was great. I mean, the increase in the value of the assets did help to bring down the MMO, which was fantastic work, and much appreciated.
Thanks.
So, all right, very good. So I think that brings us to new business. And I think we want to try to set the dates for 2022. I don't know, without Kara, I guess we'll just have to let her know. So, I mean, Pete, we meet every 6 months. You want to try to take us through this?
We usually meet in February and October of each year, the third Thursday. Again, that's what we've done. That's not to say that's what we have to do, but that would be February 17th and October 20th of 2022. Right?
February 17th and October 20th. I guess my only question about that would be, in light of some of the conversation about sort of the increasing number of retirements, if maybe we want to, like the police pension board, for example, meets quarterly. So I don't know if we want to go from 2 to 3 meetings, or if we think we're comfortable at 2. I don't know if the group has any thoughts about that before we just confirm those dates.
I think you're going to see a plateau in the retirements. We all hit the same age and time on the job. We were talking about this in our pension meetings years ago, that there was going to be a point where it was going to be crunch time, which Vince, you and I just lived through the past 2 years. There's a handful of members that I think potentially, would be eligible or would be thinking about leaving in the future. I think you'll see that, just because of age and time on the job, slow down.
Okay, fair enough. No, I'm happy to take your guidance on that and stick with those 2 dates for now and see how it goes. So do me a favor, just say those dates again so we make sure that Megan has them.
Sure. I was looking it up while we were talking, so it'd be ready. It would be Thursday, February 17th, and Thursday, October 20th. Again, just keeping with what we've always done, not that we have to.
Yeah, sure. So let's just, Megan, when Kara gets back, we'll get an email out to folks so they can put holds on their calendar. And of course, if anybody for any reason has something on those dates, just let us know as far in advance as you can. And, we'll adjust accordingly. Yeah, does anyone have any other new business?
Hi, Vince. This is Dave. I was wondering if it would be possible to have a meeting of the entire board, not involving a performance meeting, but maybe just kind of take an overview of the entire strategic, management structure that we have here. As we have, I've included myself as a relatively new board member, and we have other new board members. I'd like to have a general discussion amongst the members about, what we're doing here.
Yeah, I think that would be very appropriate. I mean, we did have a sort of performance and structure review earlier on, but of course that was before Rita was on the board, and it was a little while ago. I guess I would also just refer to the solicitor to make sure. Essentially, I think what David is asking for would kind of constitute an executive session, Jim. Is that something that we can do?
I think so. I think you have an obligation and responsibility to revisit governance issues routinely. So I think that makes a lot of sense. I think that I would confer as well with the township solicitor, but I think that if you have a very brief report of the contents and any decisions that might have been made at that meeting at your next regularly scheduled meeting in public view, that should be sufficient.
Okay, great. Yeah, no, I think that's a very good idea, and it's probably a good step just in terms of evolving governance practices for folks to become familiar with that executive session format. So I guess what I'll do is, Megan, again, let's, when Kara comes back, let's get an email out to the group to schedule that executive session, basically as soon as we can coordinate schedules and make folks available. And not so much as an item for new business or an item for action, but since it's come up a couple of times, I would just mention in terms of governance, we did really have a lot of success with the Police Pension Board going through the RFP process. We learned a lot about industry standards and industry practices, and we were able to hear from a lot of other service providers in the industry, and it really gave us a good flavor for how things went. And honestly, we didn't make any changes, but the process itself was a great learning experience and very informative and helpful. So I imagine that might be something that comes up in the future or at the executive session. So I did just want to make note of that. Any other new business? Any questions for the group?
Quick question, Vince, more of an action item. Do we need to approve the minutes from February? I know Kara did send out for you and I to sign.
Oh, that's a great point. And just reading off my agenda, we should probably make sure that approval of the minutes is on the agenda. Yeah, no. It's a very good procedural catch. So do I have a?
The other board members get those minutes, Vince? I apologize. I'm stepping all over you.
Okay, so why don't we do this? No, you're fine. Why don't we do this, Megan? Let's make sure that we get the minutes from the last meeting circulated with the meeting minutes from this meeting, and we will just approve both minutes at the next meeting after all the board members have had a chance to review. Does that work, Pete?
That works for me, Vince, sure.
Sure. Okay.
So I'll
All
hold
right.
on signing that then to send back to you.
Yeah, I guess so.
Okay.
Yeah.
I mean, it looks straightforward, but I think, in fairness, the rest of the board needs to see that as well.
Yeah, no, I think you're right, and I think it's just good to
Good practice.
get in the habit. Yeah, absolutely. So, all right. Any other new business for the group? All right. Seeing none, do I have a motion to adjourn?
I got one question. Or, I did send something to Kara to bring to your attention, Vince, about the 457. I usually, in the past, I think we do that after the pension meeting, separate thing. So,
Oh, okay.
sure that's on there too.
So let me, I do see that at the bottom of the agenda. So, I mean, just talk me through it, Tom. I mean, do we adjourn the meeting and then just stay on to discuss, or stay on with a smaller group to discuss? Like, I'm not.
I would refer that to Chief. I believe it's separate from the pension, so I think it's a separate conversation.
Got it, right, because I mean, the 457s are the individual accounts.
Correct.
And correct me if I'm wrong, I mean, those are managed by you, Michael?
Now Nationwide handles that.
Oh, got it. All right, so, all right, this is a little bit of a weird conversation to be having then. So why don't we do this? Let's adjourn the meeting, and we'll just have the trustees hang back for that discussion.
Okay, I appreciate it. I'll make the motion to adjourn.
Do we have a second? I'll second. All those in favor, say aye.
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 Opposed? All right, seeing none, the meeting is adjourned. Thank you all for your time.
Thank you, everyone.
Thank you for your service.
Yes.